The 2020 Bitcoin halving guaranteed a 700% price surge. New supply was instantly cut from 12.5 Bitcoin to 6.25 Bitcoin per block. This programmed scarcity event is the primary market driver. Bitcoin surged from $8,700 to nearly $69,000. This massive increase occurred within 18 months of the halving date. The halving is a hard-coded reduction in Bitcoin's inflation rate. This predictable supply shock drives every cyclical bull market. The market needs time to absorb the reduced daily issuance. Full price realization always follows this absorption period. The Bitcoin protocol dictates the miner reward reduction schedule. The reward is cut in half approximately every 4 years. This halving occurs precisely after 210,000 blocks are mined. The initial block reward in 2009 was 50 Bitcoin. The current reward is 3.125 Bitcoin after the most recent halving event. This mechanism ensures the total supply never exceeds 21 million coins. The halving implements Bitcoin's deflationary monetary policy. This contrasts sharply with continuous fiat currency expansion. This predictable issuance reduction is the core economic feature. It guarantees Bitcoin's inherent scarcity over time. Asset price is determined by the intersection of supply and demand curves. The halving directly impacts the supply side of this equation. It reduces the flow, which is the new coins entering the market. The stock, or total existing coins, increases very slowly. This reduction makes the stock-to-flow ratio higher after every halving. A higher stock-to-flow ratio correlates mathematically with increased scarcity. This correlation is demonstrated by scarce commodities like physical gold. If demand remains constant, reduced supply forces the equilibrium price higher. The halving immediately shifts the market supply curve leftward. This shift guarantees a higher price point for the asset. The first Bitcoin halving occurred in November 2012. It reduced the block reward from 50 Bitcoin to 25 Bitcoin. Bitcoin traded around $12 prior to this event. Following the supply shock, the price peaked near $1,150. This peak was reached in late 2013. This represented an approximate 9,500% increase. This initial cycle established the predictable market pattern. Supply reduction always precedes massive price discovery. The market capitalization was small during this period. Low capital inflows drove extreme percentage gains easily. The second halving took place in July 2016. The reward was cut from 25 Bitcoin to 12.5 Bitcoin. Bitcoin traded around $650 at the time of the event. The subsequent bull run culminated in December 2017. The peak valuation reached nearly $20,000. This cycle demonstrated a 3,000% price increase. This confirmed the powerful effect of the supply shock mechanism. Each cycle shows a lower percentage gain overall. However, each cycle achieves a higher absolute price peak. This is due to the increasing market capitalization. The peak consistently occurs 12 to 18 months post-halving. Miners must cover their operational costs for validation. These costs are primarily electricity and hardware depreciation expenses. When the block reward is halved, miner revenue decreases instantly. This decrease happens per unit of computational effort expended. The market price of Bitcoin must rise to compensate for the reduced reward. The halving effectively doubles the marginal cost of producing one new Bitcoin. Historically, the market price gravitates towards this new higher cost. The price often significantly exceeds the new production cost floor. Inefficient miners are forced out of the network. This reduces selling pressure from less profitable operations. Current market dynamics include a massive new demand factor. Regulated spot Bitcoin exchange-traded funds are now active. These ETFs require physical Bitcoin acquisition to back their shares. This creates massive sustained demand from traditional finance institutions. If daily miner issuance is halved, liquid supply shrinks dramatically. Institutional demand remains constant or continues increasing. For example, ETFs might absorb 1,000 Bitcoin daily. If miner issuance drops from 900 to 450 Bitcoin, the deficit accelerates. This structural demand guarantees upward price pressure. Previous halving cycles completely lacked this institutional demand multiplier. Regulatory clarity, especially in the United States, legitimizes Bitcoin. It is now established as an institutional asset class. The SEC approval of spot ETFs confirms Bitcoin's commodity status. Bitcoin is legally defined as a commodity, not a security. This legal framework reduces counterparty risk for large financial institutions. It also benefits major pension funds seeking exposure. Increased regulatory acceptance translates directly into higher capital allocation. This inflow of regulated capital acts as a massive demand multiplier. This coincides precisely with the program's supply reduction. Legal certainty accelerates Bitcoin integration into established wealth management portfolios. The next halving will reduce daily issuance significantly further. Issuance will drop to approximately 3.125 Bitcoin per block. This reduction means Bitcoin's annual inflation rate drops below 1%. This makes Bitcoin significantly scarcer than physical gold. Gold's annual supply increase is typically between 1.5 and 2%. As the supply approaches zero, price volatility is expected to decrease. However, the underlying scarcity value exponentially over time. The final Bitcoin will be mined around the year 2100. The predictable nature of the halving ensures its status. Bitcoin remains the hardest form of money ever created.